Morning and welcome to the Mint Asset Management update for the single sector funds, looking back to May. I'm John Middleton. Unfortunately, my colleagues are unavailable, obviously, in companies and things like that. So I will talk you through the month that was May. If we start off, I mean, I presume that the major bit of news flow, other than company reporting from May, was at last we got the two-way update for the smelter down south, which we've been waiting for months, if not years. I did scrabble around trying to find a decent chart that explained it properly, and to be honest, failed. But I think this one sort of sums up what's going on and how it affects the gentailers in different proportion reasonably well. So TY is the smelter down south. It basically consumes 13% of energy generated in New Zealand, and historically was pretty much a Meridian energy only contract. That evolved over time, as you can see in the chart. Genesis and Contact took a portion in the last 5 or 6 years, and basically it was Meridian and Contact on their own when we came to the current agreement. The good news is, yes, it's a lot of volume. The bad news is that it's a lot of volume at a pretty low price. We estimate that it's currently running at about $35. And I think therein is the rub, is that, one, we've renegotiated a contract. The good news is the price, although undisclosed, is probably double what it used to be, which is great news for all those involved historically. And I'd say it's particularly good news for someone like Meridian, because not only are they getting a better price, but also if you look from 2025 onwards, they're taking a lesser share, which means a decent chunk of that hydro generated down south can now go up to the North Island at a better price as well. So they get additional benefits as well. So we get a good long-term contract. We get sharing the contract a bit more widely with Mercury coming in, and again that sort of gives them the green light to build their wind power generation, which was announced today. But more importantly, I think it gives Contact and Meridian the opportunity to certainly generate higher earnings and probably give that more of those earnings to shareholders in the form of a dividend. So that announcement took place on the last day of the month and resulted in a very strong month, and particularly last day for most of the gentailer sector. Moving across to the different funds and starting with SRI. Essentially, it was a difficult month for the fund. Market was down and we underperformed slightly. And I think that was really because, again, we got comments out of a number of companies that the NZ sort of environment remains tough. I talked about Fletcher Building last week, or last time on the call, but in addition, we got negative updates from THL, profit warning driven by basically fewer camper vans being sold in Australia and the US. We had Warehouse coming out and downgrading earnings and changing CEO. Ryman came out with an update which was great in terms of increased disclosure, but did highlight that the underlying cash dynamics were challenging. So all in all, we got a number of sort of points highlighting that the NZ operating environment remains difficult. The fund did benefit from being underweight Fletcher Building and our positions in both of those power generation entities, Meridian and Contact. But then on the flip side, what didn't help was a big fall in tourism holdings, and Somerset and Convita under pressure, particularly when the bid was taken away. Hopefully the picture on the right demonstrates what was good and what was bad. I mean, there were a good couple of things that happened. Obviously, we talked about gentailers, but Fisher & Paykel Healthcare delivered a pretty solid result, and A2 also benefited from, I think, being used as a safe haven. But overall, a difficult time for the NZX 50. Moving across to the Australasian fund, actually a pretty good month for the fund. We managed to avoid a number of the problems and have a couple of mini successes. So a good sort of 200 basis points of outperformance. the reality is that yes, Meridian, Telex and PEXA were the main drivers of that positive attribution from overweight positions. And we also benefited from being underweight things like Fletcher Building, Spark, Ryman and THL. So overall, as I say, a decent month. And we continue to add to a number of stocks, Telex, EBOS and Megaport, and funded that through selling a bit of Chorus and Fletcher Building. One thing I would flag before I turn to Telex was interesting during the month. I mean, it seems like the macro views about New Zealand, Australia seem to be diverging. And obviously, I think, NZ is feeling it tough. And again, expectations are for a rate cut, hopefully sooner rather than later. Although I think the central bank's trying to be as push it back as far as it can. The flip side is that the Australian side of things looks to be saying, well, we're probably not going to get a rate cut for another 6 months or so, or certainly into the back end of next year. And I suppose there are a number of questions as to why that is. And I think the reality is that most Australian citizens are about to sort of experience quite a positive bump up from basically tax cuts and a number of subsidies, which is effectively equivalent to 3 to 4% of gross income. So, that's the same stimulatory impact of probably 2 or 3 rate cuts. What is happening there? Well, we've got tough tax cuts announced by the previous government, which were maintained by the current government, albeit better spread. And we've also got fuel subsidies coming through. So, the reality is, if you're fortunate enough to live in Queensland, you probably won't pay an energy bill this year. And I think that sort of stimulus from tax cuts rather than rate cuts puts pressure on the RBA to maintain rates higher for longer, albeit it's probably not as difficult for the Aussie consumer as it currently is in New Zealand. So I thought that was interesting just to flag. And again, I think Tom talked about Telex a couple of months ago when we first added it to the portfolio, and mentioned, we did expect a number of catalysts over the months ahead. And the reality is that we got a number of those catalysts in the month. Basically, a couple of their trials highlighted that their product was better than had been hoped. Again, we are talking mainly diagnostic things for basically imaging cancers in the body, and again, it was proven very good. The next phase is to get some of the therapeutics, i.e. the diagnostics, which with a bit more radiation, which will then treat the cancer, and presumably will hopefully unlock a material upside to the share price. But the reality was we had a couple of good trials. We also got the announcement that they are looking to list in the US as well as Australia, and again, a pretty positive month for that stock as well. Moving across to the property fund, again, a difficult month for the property sector. Our results, I'd say, were solid there or thereabouts, but with a negative tinge. Again, we were fortunate enough to outperform the market through a number of holdings within and outside the sector, and we'll hopefully continue to do so. Probably the main positive driver for the month was being underweight vital healthcare. To be honest, there wasn't really much news flow on the stock specifically, but the reality is there are concerns about balance sheet pressures, and also stories that, or certainly concerns that it might well fall out of one of the major property indices, which would drive a bit of selling. So that was why that was weaker. Moving across to the sector in general, basically the chart on the right at the top with the colours is essentially 4 bars sort of way of presenting how reporting season went. And at face value, it looked pretty good. Certainly, fewer downgrades than upgrades, and divvies maintained, and minor upgrades going forward. But I think that chart belies, a lot of stuff that happened underneath. The reality was that the results, while there or thereabouts in terms of earnings, were delivered with a number of sort of what I would call low-grade one-off benefits. Writing back depreciation and capex on assets that's being sold, or basically off balance sheets non-cash items that benefited earnings. the reality was that, you know, the good news, dividends were held where we'd hoped, and mind, well, there weren't really major changes going forward. But I think hopefully the table beneath that with payout ratios highlights where we see the problem. You know, first of all, you know, most companies are already pretty much spending all of their cash flow in paying the dividend, and that's fine, you know, if they're growing, but unfortunately they're not. And you know, if we roll forward and allow for interest rates, you know, remaining higher for longer, then you know, basically a number of those companies are already spending more than their cash flow, and as we go forward, more and more. So we still do see the industry as being under pressure, you know, and you know, particularly under pressure if rates stay high for longer. Yes, we probably maintain the divvy, but that doesn't mean that we're not going to feel the pressure in FY25 or FY26. So still, you know, reasonably cautious about the sector. Having said that, again, it was another solid month for the fund. Well, thank you very much for listening. As always, if you have any questions, please drop us a line to info@mintasset.co.nz, and we look forward to speaking to you in a month or so.